Shifting focus then, India's merchandise trade deficit has surged to an all-time high of $41.6 billion in the month of October compared to just $26 billion same month last year. Imports jumped 16.5% YOY, and this marked a record high driven by low base and a sharp rise in gold and jewelry imports ahead of Dussehra and Diwali festive season. In contrast, when we talk about exports, they've contracted by about 12% on a year-on-year basis in the month of October. To help us decode these numbers and what they signal for the external sector and the economy going forward, we now have Garima Kapoor, economist and senior vice president at Elara Capital, now joining us. Ms. Kapoor, afternoon, and thank you so much for joining us today. So surge in gold and silver imports has led to this current account deficit and trade deficit widening in the month of October. Do you believe this is transient in nature, or do you expect the impact to perhaps last for quite some time?
Hi, good afternoon. The numbers that we saw for the month of October are clearly transient in nature because this reflects to a large extent the massive surge in gold demand that you normally see pre-festive. Important to note that last year as well, pre-festive, the surge in gold imports was also of a similar magnitude. But when you look at the core sector, especially when you remove the impact of gold, the trade deficit, which was at 42 billion, falls down sharply to 27 billion. Even more critically, because India's service sector exports continue to remain buoyant, growing by about 15 to 17% every month on net basis, when you look at the overall trade deficit, exclude not just merchandise but also services, the number falls down to about 22 billion. Yes, there is some bit of an uptick compared to 10 billion that you saw last month, that is goods and services taken together. But we expect this to normalize because a large part of it is led by pre-festive demand for gold and as well as pre-festive demand for certain items including electronics.
Understood. So you believe that this is transient in nature. But Ms. Kapoor, let's also talk about exports because they too were soft in the month gone by. Let's talk about IT services export or services exports in general. Do you expect that to ramp up going forward, especially because of the kind of uncertainty that we are seeing in the global market?
The IT service exports in India, the character of IT service exports has changed. What you're seeing in terms of headline numbers for most IT companies is not the real reflection of what you're seeing in IT service exports. A large chunk of these exports are led by the mushrooming and the explosion of global captive centers in India. Remember, post-COVID, India became a hub for global captive centers. Now, assuming the H-1B visa restrictions in US go through and the added cost of basically keeping and hiding every additional H-1B visa remains very prohibitive, then as an alternate service model, you will see further expansion of GCCs. So we do think this trend of global captive centers led export growth in India is something that is going to be durable in nature and the sustainability of which can be seen in some of the lead indicators of number of square feet area that GCCs in India are acquiring. And hence, I think it looks a trend that is fairly sustainable over the next 2 years for sure.
Has been the trend when it comes to export and its impact, tariffs and its impact on export? I understand we are still in talks with the US when it comes to signing a trade deal. Perhaps it could take some more time. What kind of impact is that likely to have on the economy and the broader market at large?
If you look at dissection of what's really happening on exports, there are three segments that are getting impacted because of US tariffs. One is gems and jewelry, second is marine exports, particularly shrimp exports, and the third category is textiles. But interestingly, as we speak, what's really happening is that while the share of US has come down from the beginning of the year, which is about 34% to somewhere about 28% right now, as a basket of a total merchandise exports, the share of other countries, particularly using UAE, Hong Kong, Spain, China, is beginning to increase. So, what we're really seeing is a diversification that is underway of India's export market, number one. Number two, very interestingly, while we do tend to look at only the impact of US tariffs, there has been an impact of European tariffs on Russian oil as well, which has really led to a decline in India's refining exports. So if you look at the oil refining products, they are now seeing a degrowth, reasonable double-digit degrowth so far this financial year. But that also means that when we dissect the impact of this, while India-US trade deal may help to balance and improve the outlook for exports of shrimps, gems and jewelries, and to some extent that of other labor-intensive products like textile, something like of that of oil processing units, or probably as we call as refining products, is something that is unlikely to correct anytime soon because it is led by the European sanctions.
Okay, and perhaps we could see some kind of relief come in as far as the tariff is concerned, and a deal could be signed over the next few days. Ms. Kapoor, thank you so much for taking your time out and joining us this afternoon and helping us understand what the impact of import-export trade will have on trade deficit going forward. Thanks so much for joining us today.